Philip Morris International just beat their second quarter 2026 consensus expectations. And honestly, they kind of fundamentally rewrote the narrative of their business today. Let's look at the numbers.
Yeah, the numbers are huge. Adjusted diluted earnings per share came in at $2.20.
Right, which is a 15.2% increase year over year, or I think 13.6% if you strip out currency impacts.
Exactly. And that beat expectations largely because of some really favorable transactional effects.
Though we do have to mention right up top, there's a pretty glaring contrast. The reported EPS actually declined 7.7% to $1.80.
Yeah, that 40-cent gap between reported and adjusted is significant. We are going to get into exactly why that happened later, but I mean, the underlying cash generation is just massive.
It really is. Especially when you look at the top line. I mean, history was made today. Net revenues crossed the $11 billion mark for the very first time.
Hitting $11.2 billion to be exact. That's a 10.4% reported increase or 7.6% organically.
It's just staggering. And management clearly feels confident because they raised their full year 2026 adjusted diluted EPS forecast too.
Right. They bumped it up to a range of $8.26 to $8.41, which, represents about 9.5 to 11.5% growth over 2025.
And the market absolutely loved it. Shares popped on the open as investors digested everything. So that brings us to our mission for you today. We are acting as your financial analysts, ripping through the details of this Q2 earnings report.
Because there's a lot of noise, and we need to separate that from the actual fundamental drivers of this quarter's beat.
Exactly. We're not just going to read you the income statement. To really understand how a supposed legacy tobacco monopoly generates a record $11.2 billion in a single quarter, we have to look at the dual engines of their business.
Yeah, you have the smoke-free transition engine on one side and the legacy combustible cash cow on the other.
So let's start with the smoke-free segment, or SFP. The narrative for years has been that smoke-free is the future, but looking at these numbers...
The future is already here. I mean, SFP now accounts for 42% of total net revenues. Wow.
Yeah, that's up half a percentage point just from last year. Shipments across the board increased by 7.5%.
And a lot of that is driven by IQOS, right?
Heavily driven by IQOS. Heated tobacco unit, or HTU volumes, grew 7.6% globally. And then you have their e-vapor product, VEEV, which saw massive 55.1% shipment growth.
That's crazy.
It is. VEEV actually just took the #1 closed pod position in Europe.
Okay, let's unpack this, because when I look at the sheer dominance of IQOS, I mean, they hold about a 75% volume share in the global heat-not-burn category.
Yeah, it's practically a monopoly in that specific subcategory.
Right. To me, this doesn't feel like a traditional consumer packaged goods dynamic anymore. It feels way more like a tech giant building, like an inescapable hardware and software ecosystem.
Oh, that's a really good way to look at it.
Yeah, like you get the consumer to buy the IQOS device, which is the hardware, right? And then they're fundamentally locked into buying your specific HTU consumables, the software over and over and over again. And it goes even deeper than a standard tech ecosystem. Because, with a smartphone, a consumer might upgrade the hardware every 3 or 4 years. But the IQOS device requires daily software purchases.
Right, they're buying those HTUs constantly.
Exactly. The lifetime value of that locked-in customer is just staggering.
So the device acquisition cost is basically just a psychological barrier to entry.
Totally. Once they cross it, those HTUs provide this incredibly sticky, recurring revenue stream.
But to fund that tech-like expansion, to build out all that infrastructure, you need cash, like lots of it.
Which brings us to the legacy combustible segment. Traditional cigarettes.
Right. And despite this massive corporate pivot to smoke-free, traditional cigarettes were incredibly resilient this quarter. Net revenues here grew 9.5%, or 6.1% organically.
That resilience is the critical variable. It's the cash cow funding the whole future.
Wait, I have to jump in here because there is a data point on this that is genuinely shocking to me. Management pushed an exceptional 10.0% pricing increase across their global combustibles segment.
10%, yeah.
10%. In any normal consumer category, if you hike prices by double digits, your volume falls off a cliff. People buy cheaper alternatives or they just quit buying entirely.
Right, they trade down.
Exactly. Yet, cigarette volume globally still grew 1.1% for PMI. How is that even economically possible?
What's fascinating here is the sheer inelasticity of this pricing power. You're looking at a product where consumer demand does not behave rationally compared to other consumer goods.
It's like owning a toll bridge, where the toll hikes up 10%, but somehow traffic actually increases.
That is a perfect analogy. And you also have to factor in the geographic mix, right? That 1.1% volume growth was heavily driven by emerging markets. We're talking Turkey, Indonesia, Egypt.
Oh, interesting. So it's very regional.
Yeah. In
Yeah.
some of these developing economies where maybe inflationary pressures are high across the board, cigarettes act almost as a consumer staple. Brand loyalty simply trumps price sensitivity.
And the brand loyalty for Marlboro is still unmatched, apparently.
Unmatched. Marlboro continued to gain market share, actually matching its record category share of 11.0% globally.
Which is wild. And that cash is exactly what's funding the capital expenditures for the smoke-free transition.
Precisely. They are single-handedly using that legacy cash flow to build out the science and manufacturing for the smoke-free future.
Well, it's one thing to grow revenue by raising prices, right? It's another to see how much of that cash actually makes it to the bottom line. So let's look at margin flow-through.
Which is really the core of the bull thesis for PMI right now.
Yeah, because gross profit increased by 11.5% in the quarter, or 8.7% organically. But the crucial takeaway for you, as the listener trying to figure out this business, is that SFP is not just the future. It's already more profitable.
Significantly more profitable. The smoke-free adjusted gross profit margin sits at 70.1%.
Wow!
Yeah, compare that to the combustible segment, which is at 67.9%.
So because smoke-free is growing as a percentage of the total revenue mix, hitting that 42% mark, it's mathematically dragging the overall company margins upward.
Exactly. Total adjusted gross profit margin expanded by 0.7 points to 68.5%, and operating income jumped a massive 22.0% or 10.7% organically.
It just perfectly proves the international thesis. The faster they convert legacy smokers to IQOS and VEV, the more profitable the whole enterprise gets.
It does prove it internationally, yes. But, and this is a big but the valuation multiplier for PMI often hinges on the U.S. segment.
Right.
And right now, the U.S. market is proving to be a totally different beast. Let's look at what's happening with ZYN.
Yeah, let's pivot to the U.S. because while international markets are humming along, the U.S. segment saw a slight sequential improvement, but still posted a 0.7% year-over-year net revenue decline.
Yeah, top line growth there is basically flat. ZYN shipments did increase slightly, up 1.8% to 2.9 billion pouches.
But the actual offtake volumes, meaning the product consumers are actually pulling off store shelves, were essentially flat.
Right. And management blamed an uneven competitive landscape for that. Basically, aggressive discount competitors flooding the market and stealing share.
But here's where it gets really interesting. Look at how PMI is strategically maneuvering to crush those discount brands. They just launched ZYN Ultra-RA, which includes 9 milligrams and 11 milligram variants.
Right, higher nicotine strength.
Yeah, and they're specifically pricing them to capture those price-sensitive consumers who might be tempted by the cheaper off-brand pouches.
They are meticulously segmenting the market, but honestly, the regulatory moat they are building might be even more significant than the new product.
Oh, you mean the FDA authorizations?
Yes, they just secured FDA MRTP-modified risk tobacco product authorization for 20 different ZYN variants.
Which is huge because, just to clarify for everyone, that makes ZYN the first and only nicotine pouch to ever achieve MRTP authorization from the FDA.
Exactly, the first and only. The barrier to entry for that authorization is incredibly high. It takes years of clinical data. The discount competitors simply do not have the balance sheets to replicate that.
No, they definitely don't. But building that moat and expanding the product line is costing PMI serious money right now. U.S. segment adjusted operating income dropped quite a bit.
It did. If we connect this to the bigger picture, management has explicitly stated they plan to aggressively accelerate U.S. investments in the second half of 2026.
So they are intentionally taking a margin hit right now.
Totally. They aren't just defending ZYN's market share. They are prepping the battlefield for the upcoming launch of IQOS ILUMA in the United States.
So they're building out manufacturing facilities. They're spending heavy capital now to dominate later.
Exactly.
Well, with all those heavy investments planned for H2, we really need to look at the immediate risks and structural headwinds they're fighting, because it's not all smooth sailing.
No, there are definitely global roadblocks, though a lot of them seem transient.
Like what's happening in Japan, right?
Yeah, Japan is a perfect example. It's a massive market for them, but HTU adjusted in-market sales actually declined there.
Because of the pantry deloading.
Right. Japan had an April 1st excise tax hike. So in Q1, consumers hoarded product. They loaded their pantries. Then in Q2, they worked through that stash and didn't buy as much at retail.
So it looks like a drop, but it's just an inventory phasing issue.
Exactly. And honestly, IQOS still maintained a 68% share in Japan exiting June. They've been using their Sentia product line to catch the really price-sensitive consumers over there.
Okay, what about Poland? Because they had some regulatory headwinds there, right?
Yeah, Poland instituted a characterizing flavor ban. You can't sell heated tobacco with distinct flavors like menthol or fruit anymore.
Right, which forces consumers to unflavored tobacco, and you inevitably lose some volume there.
You do. But despite that ban in Poland, European IQOS HPU sales still grew by an estimated 5.1%.
That's pretty resilient. Okay, I want to pivot and ask you to explain something we brought up at the very start of the show, the impairment charge.
Oh.
Because that is the massive drag on the reported EPS. There's a 40-cent gap between adjusted and reported earnings. Explain this. $511 million non-cash impairment charge related to RBH, their Canadian affiliate.
Right, so deconsolidated affiliate non-cash impairment sounds like terrible accounting jargon.
It really does.
Yeah.
Let me try an analogy. Think of it like buying a house, right? You buy a house for $500,000. It's on your personal balance sheet for that amount.
Okay, following.
But then the neighborhood changes, the market shifts, and an appraiser says, actually, this house is only worth $100,000 now.
Right.
You didn't physically lose $400,000 in cash out of your bank account today, but you have to adjust your books to reflect the new reality. Is that what happened with PMI in Canada?
That is a perfect analogy, yes. The industry environment in Canada deteriorated, so PMI's accountants had to lower the estimated fair value of RBH on their books. They took a $511 million hit on paper.
On paper. Okay, so that equates to roughly 33 cents of diluted EPS dragging down the gap reported earnings.
Exactly, but it's non-cash. It doesn't impact their actual operating cash flow for the year, which is still incredibly healthy.
Okay, good to clarify. Now, are there any actual macro risks that could impact real cash costs?
Definitely. Management did briefly mention the ongoing conflict in the Middle East.
Oh, right. Has that shifted consumer behavior?
Not visibly yet in terms of purchasing, but it has absolutely increased transport logistics and energy input costs. And they've had to bake those friction costs into their full-year guidance.
Makes sense.
This raises an important question, though, regarding those U.S. margins we talked about.
How so?
Well, we have to see how much of the current U.S. margin pressure is truly just temporary inventory phasing versus structural manufacturing costs tied to this footprint expansion. Management is targeting a net debt to adjusted EBITDA ratio of close to 2.0 times by year-end.
Which means they really need the U.S. margins to stabilize soon.
Exactly. So they can fund the ZYN defense and the IQOS ILUMA rollout without over-leveraging the balance sheet.
Wow. Okay, we have ripped through a lot today. The dual-engine performance, the, frankly, shocking inelasticity of their pricing power, the strategic U.S. investments, the macro headwinds.
It's a very complex quarter, but a very strong one.
It is. And when you synthesize all this, it leaves us with one final provocative thought for you to mull over.
Let's hear it.
With smoke-free products now generating 42% of revenue at a 70+% gross margin, right? And with 43 million users globally locked into this recurring revenue ecosystem, plus those FDA authorizations, building huge regulatory moats.
Right, all of that.
At what exact percentage point does Wall Street stop valuing Philip Morris as a legacy, declining tobacco stock, and start pricing it like a high-growth FMCG wellness and tech company?
That is the million-dollar question. I mean, that potential multiple expansion is the absolute core of the long-term investment thesis here.
So what does this all mean? It means the fundamental transition of this company is happening faster and more profitably than most analysts expected. But that battle for the U.S. market in the second half of this year is going to be incredibly expensive and highly competitive.
It's going to be fascinating to watch.
Absolutely. Make sure to follow the show for daily, no-nonsense earnings coverage so you never miss the financial details that actually matter.